Half the country is waiting for sub 3% rates to come back. They're not going to come back, probably, most likely. But by the end of this video, you're going to know exactly what to do instead. I'm going to show you the math on what waiting is actually costing you right now. And I'm going to show you the play I use with clients to get a better rate without paying extra for it. So stick with me to the end for the math, because that's the part nobody else is willing to put on the screen. I'm Dustin Hutley with Envoy Mortgage, and this video is for anyone who's been sitting on the sidelines telling themselves they'll buy when rates come back down. Let me start with the part most lenders won't say out loud. 6% isn't a crisis, it's normal. The 30-year fixed mortgage has averaged around 7.5% since 1971. That's the long-term average. The sub 3% rates we saw in 2020 and 2021 weren't normal. They were the result of a global emergency that pushed the Federal Reserve to drop interest rates to zero to keep the economy from collapsing. That window was a once-in-a-century event, not a baseline. But for most people watching this, sub 3 is what feels normal, because it's the last thing they remember before they start thinking about buying. That's called recency bias, and it's costing people years of their life that could have been spent building equity in a home instead of writing a rent check to somebody else. Here's where most people get this wrong. They look at 6% and they think it's bad because they're comparing it to 2 3/4. But the right comparison isn't to a number that existed for 18 months in your lifetime. The right comparison is to the average over the last 50 years. And on that scale, today's rate is squarely in the middle. Okay, so if sub 3 isn't coming back, what should you actually expect? Let's look at what the people whose job it is to forecast this say. Fannie Mae's most recent projection has a 30-year fixed easing toward around 6% by the end of 2026. Morgan Stanley is forecasting lower than that for the back half of the year. The Mortgage Bankers Association has a similar trajectory. None of those forecasts put us back at 3. The most optimistic ones don't put us back at 4. Now, I'm going to be straight with you. Nobody actually knows the exact path. Rate forecasts are wrong all the time. What we know with high confidence is the direction, easing slowly from here. What we don't know is how fast or how far. So if you're waiting for rates to drop, here's the question I want you to ask yourself. Drop to what? To 5, 5.5? Probably eventually. To 3? Almost certainly not. That changes the whole math. Before I show you the math on what waiting actually costs, I want to make sure you understand something. The reason most lenders won't put this on the screen is that the answer makes their easiest sale harder, not easier. The easy sale is rates are coming down. Lock in now before they move. The honest answer is more complicated than that. And the honest answer is what I'm about to walk you through. So here's the math. Let's use a real Vancouver number. A median priced home in Vancouver right now is around $489,000. Let's call it $450 for round numbers. You're renting for around $2,000 a month while you wait. If you wait 2 years for rates to drop, well, here's what happens. 24 months of rent at $2,000 a month is $48,000. That money is gone. You don't build equity. You didn't get a tax deduction on the interest. You didn't get any appreciation on an asset. You just paid a landlord. In those same 2 years, Vancouver home prices have been forecast to appreciate 1 to 4% a year. Let's split the difference and call it 2.5. On a $450,000 home, that's roughly $11,000 a year, or $22,000 over 2 years. So the house you would have bought today for $450,000 now costs you about $472,000. So far, the cost of waiting is $70,000. 48 in rent, 22 in appreciation. Now let's say rates do drop. So they go from 6.25% today to 5.25% in 2 years. That's a 1% drop, which is actually on the optimistic side. On a $400,000 loan, a 1% rate drop saves you about $250 a month. Over the life of the loan, that's real money. But you don't get the life of the loan back. You get the difference between today and 2 years from now, which is about $6,000. So you just saved 6. You spent 70. That's not waiting for a better deal. That's just losing more slowly. Now, I know that math feels uncomfortable. It's not what most people on the internet are telling you, but it's the actual math. If what I'm saying is making sense to you so far, please hit subscribe. I drop one of these every week, and they're the kind of content nobody else in the industry is willing to make. Okay, so if waiting doesn't work, what does? This is where the buy down comes in. Here's the line I want you to remember. Marry the house, date the rate. You're not committing to today's rate for 30 years. You're committing to the house. The interest rate is something you can change later through a refinance. And in the meantime, you can buy down the rate up front to make the payment work today. Or better yet, you can have the seller pay for that for you. A buy down is exactly what it sounds like. You pay a fee at closing in exchange for a lower interest rate. Sometimes that lower rate is just for the first year or two. Sometimes it's permanent. The most popular version right now is what's called a 2-1 buy down. Your rate is 2% below the note rate in year 1. 1% below in year 2. Then it goes to the full rate in year 3. Here's the part most people don't realize about temporary buy downs, is that the sellers are the only ones that are even able to pay that for you. Especially right now when the market has cooled enough that sellers are looking for ways to move the houses without dropping the asking price. A 2-1 buy down costs the seller roughly 2% of the loan amount, but it makes your monthly payment look very different in those first 2 years. I had a client recently who signed up for a buy down specifically to get a better rate. And through how we structured the deal, they didn't pay another cent for it. The seller covered the entire thing as part of the negotiation. Matter of fact, we do this all the time. So the client got 2 years of significantly lower monthly payments without writing an extra check. So that's the play. You don't wait for the rate to come down, you buy it today, you negotiate a buy down into the deal, you ease into the full payment over a couple of years, and you refinance whenever rates actually do drop. And here's one thing that nobody really talks about is the reason this whole wait for rates narrative is so loud is that it gives people permission to not act. It's a socially acceptable reason to keep renting and avoid the harder conversation, which is whether you actually qualify and what your plan looks like. And the longer you stay in that conversation with yourself, the further behind you will fall. So here's what I want you to do this month. Whether you think you're a year out, 6 months out, or 6 weeks out, get your approval plan built right now. Find out where you stand today. Find out what programs you might qualify for that you don't even know about. Find out what your monthly payment would actually look like at today's number with a buy down layered on top of it. The best time to start this conversation is before you think you're ready. The worst time is 2 weeks before your lease ends and your landlord just raised the rent. If you want help building the plan for your specific situation, the link to book a call is in the description. 20 minutes, no pressure. We just look at where you are today and we build the path forward. If today's not your day to buy, we'll figure out which day is. And if today is your day, we'll get the plan locked in so you can move when the right house shows up. Take care, and we'll see you in the next video.